Here is the monetary policy statement for February 2015. Inflation remained subdued in January 2015, with annual headline inflation declining to 1.3% from 1.8% in December 2014. Annual core inflation remained stable at 2.7%, the same level as in the previous month. The current low levels of inflation are largely driven by the decline in food prices in 2014 due to a good domestic harvest, lower global inflation, and the decline in crude oil prices. The Bank of Uganda has frequency indicators of economic activity. The Bank of Uganda's high-frequency indicators of economic activity point to a pickup in real economic activity over the last 6 months of 2014. This lends support to the projection of 5.5 to 6% for real growth for 2014-2015, which is in line with the economy's estimated medium-term potential output growth. Growth in 2014-15 is supported by increased public investment and the recovery of the private sector credit, which in turn boosts private investment and consumption. Since the previous meeting of the Monetary Policy Committee in December 2014, several developments have affected the medium-term inflation outlook. The sharp depreciation of the exchange rate, which occurred in January 2015, will raise the domestic prices of traded goods. However, the lower global oil prices and domestic food crop prices, to the extent that they persist during 2015, will dampen inflationary pressures. Taking into account of these developments and the projected strength of economic activity in 2015, the Bank of Uganda forecasts indicate that core inflation will gradually rise to a range of 4 to 6% over the next 12 months. The inflation and growth outlook is subject to several risks, both domestic and external. Key risks for the economy include a widening trade deficit, the possibility that investments in the oil sector will be delayed given the fall in global oil prices, possible volatility in global financial markets, and an acceleration of domestic demand growth beyond what is currently projected. Given the medium-term macroeconomic forecasts and the balance of risks, the Bank of Uganda believes that the current monetary policy stance is appropriately configured to deliver Bank of Uganda's medium-term objective for core inflation of 5% and to support sustainable real economic growth. Therefore, the Bank of Uganda will maintain the central bank rate, CBR, at 11% until the next MPC. The band on CBR will be maintained at plus or minus 2 percentage points, and the margin on the rediscount rate at 3 percentage points on the CBR. Consequently, the rediscount rate and the bank rate for February-March 2015 will remain at 14% and 15% respectively. This is the February monetary policy statement.